Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets, what we're looking at in some of our portfolios. As always, please don't use these videos for trading purposes. They're for education only. Always start here with the weekly chart of the S&P 500, which shows about let's see, we go back to 2019 over here. So we got about 5 years of trading. Each one of these candlesticks is a week. And you can see the COVID sell off and then the post rally after that as all the money flowed into the markets. 2022 was pretty miserable here as we started a bear market as the interest rates were raised by the Federal Reserve. But then started 2023 actually turned out very well, even though a lot of pundits calling for this to continue downward. Actually broke trend and went higher. As you can see here, I highlighted some support points here. That's the all-time high there. And then big support point here around 42.50. We did break above that and then it came back for a couple of weeks there. And now we'll see if this trend continues. But as you can see here, I've drawn the trend line on it, and the weekly chart, the longer term, is up, which is nice. And many of you may be seeing that in your 401ks, kind of recovering a little bit from 2022 there. If we come down into a little more detail, this is the daily chart of the S&P 500. And this gives us about the last maybe 2 years of trading. And you can highlight the really super choppy nature of 2022 as it just kept working its way lower with obviously some really big rallies here that happened, but still kept making its way lower. And then finally, the tables turned here. It looks like around April, we went back long into the market, started adding risk again, and that's great. We had a nice rally through early part of the summer. Obviously here, ours has turned into a little trouble, but maybe nothing too bad as of yet. Still trending upwards. As you can see, I've drawn the trend line on there. So I'd say from the long-term perspective, longer-term money, it's still positive. We're still in an uptrend. Certainly getting closer to rolling over, but that has not happened yet. And we try to just follow along with what is happening. If we look at here in a little more detail here, this is a 2-hour chart of the S&P 500. And this will show back to, this is March here all the way on the left. And it gives us a nice look at the kind of shorter term trend that's happening. Here was the downturn that we had in August, and then that broke higher. So we were able to, at least in my portfolios, I was adding a little bit more risk back on here that we were protecting during that downside. And here it almost looks like a bit sideways that we've had for the last couple of months if you take out a big picture of it. So maybe that's what's happening. The last few days it had definitely been rolling off a bit, but seems like the market at the very least is just going into a sideways. So no change in the longer term trend, which right now is up. If we come down here and look at really the problem that's caused all this, this is the interest rate on a 10-year U.S. bond. And you can see here at the start of COVID, it got cut way down. Where that's about 0.5% is where it was down to was the 10-year rate. And then as the Federal Reserve came in and started raising rates, we now find ourselves at about 4.2% on the 10-year. For the last nearly a year here, we've been sideways. So it came all the way up here in September, October last year, and then rolled off a little bit, which allowed the stock market to recover. But now it's been sort of going sideways here, as you see, a little choppiness back and forth. But I don't think the market's going to take it too well if the interest rate should go much higher out of this area here. So keeping a very close eye on that, especially as that was the height of the problems with the stock market was really from the interest rates being raised by the Federal Reserve. We come and look at some of the economic data. We go here to trading economics. I love the site, gives me a lot of good data here. The GDP annual growth rate for the U.S. The last one is 2.6. Previous reading was 1.8. So those are still positive. You hear a lot on CNBC and different pundits saying, okay, we're going to have a recession, and sure that could happen, but it hasn't happened yet, and data isn't showing up pointing to it as of yet. So for the time being, we can stay in here and still make money for our clients. In terms of the other one, I like to look at non-farm payrolls, the jobs number. We added 187,000 in the last reading. Reading before that, 157,000. So it's still positive, still moving upward, even though these aren't giant, strong numbers. Inflation rate, that's on everybody's mind. We were at 3.23 in the last reading. That's certainly better than the 8 or 9 that we were getting about a year ago. And then if we come down here to retail sales, that's a big one too. I like to see the consumer spending, and that's still, these are positive numbers. They're not great, but they are still continuing to be positive. So no signs in the economic data yet that we'd be concerned about a recession. Then if we look here at forward earnings, this is analyst estimates of what the S&P is going to earn, the companies in the S&P are going to earn. And you can still see that it is a positive trend going forward. So perhaps even if there is a recession, a slowdown, what have you, the stock market tends to look at the earnings of the companies, not just the condition of the economy out there. I'd caution people that the economy and the stock market often separate from each other and don't stay locked in. Finally, look here at the PE of the price earnings ratio of the S&P 500. And as you can see, going into 21, it was very, very high. That's dangerous and would preclude I guess can't think of the word, but would be predicting a recession or at least a sell-off. And eventually we did get one there in 2022. So right now the PE ratio is about 25. So maybe a little high, but certainly not out of the realm of normal. Did want to look to, I forgot one thing to go over here on the 2-hour chart as we were saying going a little sideways. Let's look at some of the breadth of the market here. This first line here is the percentage of the S&P 500 that's in an uptrend. In July, it had gotten up to 80%. As you can see, as we were rallying up here, definitely started to sell off. It's been selling off. Certainly, we're down at about 53% right now, although for the last few weeks it has stayed steady. So we're not seeing a big decline past what happened. So I'd say that's a little concerning that it's down at this number, but not terribly. So next line down is the advanced decline line on the New York Stock Exchange. Just shows the number of shares advancing over number of shares declining, and same thing. I'd say that's been flat. And in fact, it didn't really roll off from its high. It's just gone flat for a little bit. And finally, the bottom number is the VIX, the volatility index, and this is predicts the volatility in stocks. It's in the options market, and that's been low and flat. We're talking 14 there. Generally, if you're going to see a big sell-off in the market, you're going to see that thing start to spike as people start to pay more for options that can protect their portfolio. So for the time being, again, sure, we're seeing, if we go here to the daily chart, maybe it's threatening to change trend, but it certainly hasn't yet. The internals are strong and or at least okay, and we haven't seen any economic data to really worry us yet. And of course, the long-term picture here, the weekly chart is still in an uptrend. So for now, we are staying invested and just watching carefully. I hope this was informative, helpful, and I hope you'll tune in for the next videos, and please contact us if you'd like to hear more about what we're doing for our clients. Otherwise, hope it was informative, and we'll see you at the next update. Thanks so much.